Welcome back to Red's Roundup. In this video, we're looking at the makings of a multibagger, part 2. If you haven't seen the earlier episode, go back one video, take a look. Let's get into it right now. In the last video, we ended with the high-level key takeaways. We're just going to run through these quick as an overview, as an intro to what we're going to be seeing in these top 5 companies. So number 1, we're looking for businesses with advantageous positioning. 80% of businesses had high barriers to entry, and 91% had moderate to high competitive advantages. That's key. Spend time on financially healthy companies. 88% of outperformers came from a position of financial health. Acquisitions can create value. Don't rely on multiples alone, and be open to international investments. And then we have specific takeaways. Look for companies in the UK, Sweden, Germany, Norway, and Australia. Companies in tech and healthcare outperform, on average, a larger percentage of the time. And companies under $2 billion of market cap represented 84% of the multi-baggers. And you're really looking for companies with below 3 times sales, below 20 times EBITDA, and below 30 times PE ratios for these companies that you're screening for. So I'm going to be running some screens. We see here a table of contents. We're going to just be going through the top 5 right now. So number 1, we have Zynex Medical, traded on the NASDAQ with the ticker symbol ZYXI. And surprisingly enough, this company almost returned 100 times in 5 years, stopping short at only 91 times its 5-year total shareholder return. This company comes in at rank 1. So Zynex Medical is a medical device manufacturer that produces and markets electrotherapy devices for use in pain management, physical rehabilitation, neurological diagnosis, and cardiac monitoring. So in 2015, it was trading for 22 cents per share. It had a market cap of $6 million, an enterprise value of $11 million, and it was trading at an enterprise LTM revenue of 0.62. So this is pretty impressive. And then it ended with a share price of $21. Remember, that's a 9,000% increase. That is massive increase. So what drove the growth of this company? We see it was their primary product, Zynex Medical, non-invasive electrotherapy pain management devices that require a prescription and are generally billed to insurance. So we see here a picture of their device that is attached to a human body here, and we see that it's being used and it works. So ZYXI is a pain management product company. Products treat chronic pain and acute pain through electrotherapy. So this is interesting. If you know a lot about medical devices, you could have seen this product coming. That would have been pretty good. Here we see global electrotherapy market, manufacturing and distribution of a variety of electrotherapy treatments and devices for a variety of issues such as spinal cord issues and neurological disorders. So what's the competitive landscape look like? ZYXI, Zynex, is one of the largest American players, but the industry remains fragmented. Getting FDA approval for a novel electrotherapy system device remains key point of competition. So they actually have pretty good competitive advantages. They have high barriers to entry, significant research and development costs, and a sales force is needed to communicate with physicians and therapists. So this is key. We saw this in the high-level takeaways and the key takeaways, that you're going to want competitive advantages, barriers to entry, and just attractive overall return possibilities. So what changed in the industry? Higher prevalence of neurological disorders anticipated to drive future growth. Opioid pandemic sadly contributed to the possibilities of new pain treatment devices. And then this catalyzed trend away from drug-based treatments. So what investors missed when the company was trading for 22 cents 5 years ago? I can't believe that. From 22 cents to almost $22. That's incredible. So what was the bear thesis? Existential concerns, uncertainty whether the company will remain is a going concern. So liquidity issues, default on credit facility, skepticism over their growth prospects. So they weren't actually a growth company at that point. They hadn't actually become profitable at that point, so they were struggling to survive. And then here we see why those points were wrong. Zynex survived. They had heightened cash flow from operations, and it repaid its credit facility that was in default. Its revenue grew by almost 300%. It maintained gross margins of over 80%, and sales reps increased to 140. So they really maintained a great sales force, increased revenue, and just a great growth story that was trading at a pretty reasonable price if you look at it. And remember, this is a micro cap company. If you look at my other videos, you know that I'm a fan of micro cap investing, and this is perfect reason why, because you have the possibility for much larger shareholder returns over time. Okay, so Zynex Takeaway. Zynex is a decent business. They basically say this isn't a huge outlier. It probably won't continue to return large amounts of capital to shareholders in terms of share appreciation. It's probably more of a one-off thing, with the fact that it increased 91 times in 5 years. They don't anticipate that to continue into the future. So can Zynex sustain its current market position? It's saying sort of yes and no. The industry is increasingly more competitive. Will it grow faster than the industry? Yes and no. Unsure. Is Zynex poised to continue to outperform the market? They say no. They say they are not going to continue to outperform the market. So sadly, you're going to need to look in other businesses for future multi-baggers. Next one, Endor. Trading, I think that's Munich. I actually don't know. Ticker symbol N2N. I didn't know that you could use that for ticker symbols. So shareholder return of 8,217% in 5 years. This is coming in at number 2. So overview, Endor AG is a gaming accessory company based in Bavaria, Germany that sells high-end sim racing gear under the brand name Fanatec. So in 2015, they were trading at a stock price of 1.04 euros. And in 2020, they trade at a price of $112. So massive shareholder return there. They were at a market cap of 1.85 million euros in 2015, increasing to over 200 million euros in 2020. They were trading at a 3 times PE ratio in 2015, and they currently trade at a over 200 times PE ratio, which is pretty absurd if you think about it. Going from a 3-4 times PE ratio to trading at over 200 times earnings. That's pretty remarkable. So we see their revenue almost increased by 4 times, not quite. Their EBITDA increased by about 3 times, so that's pretty good over the past 5 years. So what were their primary products? So remember, they're a gaming company. They created gaming equipment, so for racing games, wheels and bases, wheels to steer in these games, like on an Xbox or computer or something, pedals used to speed up and brake in the game. So this is interesting, a gaming company. I wouldn't think a gaming company would come in at number 2, but apparently it does. So E2N provides its customers with high-quality sim racing expertise, and their customers know what they want from their gaming equipment, obviously, in this company. Makes the best. You see here, heavy-duty metal parts and genuine leather. They're committed to quality over quantity in terms of their gear. This is a key you might see in a lot of businesses that are going to be successful, that they're going to be committed to quality and committed to the customer. It's sort of like Apple, the Apple phenomena. So let's look here. The players in this industry offer hardware products to enhance video game software. with the goal of making games more realistic. So the market structure is oligopoly, the market size of 8.25 billion, industry growth of 10%. So barriers to entry, license agreement with consoles, no extremely material barriers to entry in terms of capital requirements. So competitive advantages, extremely high quality products. Like I was saying before, the extremely high quality is what sets this company apart from others. So its risks, its supplier and licensing concentration. Each product is only manufactured by one or two suppliers. That is still not so good. And what changed in the industry? VR gaming has become much more prevalent. Esports is more of a phenomena now. Let's take a look at what investors missed. So the bear thesis 5 years ago, Endor was and still is a microcap stock without any English financials that is listed on a small stock exchange. Yeah, so if you're like me, you speak English, you don't really speak any other languages very well, maybe you took a little bit of another language, you're looking at this, you're probably not going to be finding the next Endor because their financials are not listed in English. So that's going to be a struggle for you and me as investors who speak English only to try and find this company, considering their financial reports were more than likely published in German. So sadly, that's not possible, but we can still take away these big points about what these types of companies, what their characteristics are, and that's really what's important in this series, is to look at what is the characteristics of a multibagger. What does it mean? Okay. So it's a good business. It has competitive advantages. It's going to continue to grow and is poised to outperform. So this is one, maybe if you speak German, go read their annual reports. But me, I think I'll pass just for the plain fact that I won't know what the heck is going on with the company because I don't speak German. So I think I'll pass on this one, sadly. But if you speak German, give it a look. So next one, Xebec, a world powered by clean energy. Rank number 3, 5-year total shareholder return of 4,712%. It's, again, very good. So we see here the stock was trading for 7 cents in 2015. So it's a penny stock. And in 2020, it's trading for $4. So still a penny stock, but a massive shareholder return. And the market cap has increased from under $3 million to over $300 million. That's pretty impressive. So here, it actually did not have a PE ratio, and now it has a PE ratio of 46. So they increased revenue from $11 million to $49 million, and we see here that much of the returns actually occurred in 2019. It was pretty steady, but then in 2019, boom, share price just explodes. So what does Xebec do? So they design, engineer, and manufacture equipment used in the production of renewable natural gas. They support and maintain services for customers that are using Xebec products, and they develop renewable gas assets to produce and sell RNG. Xebec is a renewable natural gas company, and so we can see their sales by division are split up into two categories: their support and system sales. So we see here that their systems is what makes up the bulk of their returns in terms of sales and geography. They actually have operations all over the world, which is a pretty interesting thing, that they make money all over the world as a microcap company, which a lot of times microcap companies won't have access to all the different parts of the world because they are so small, but this company is different. Xebec, as an added note, is a highly capital-intensive business, meaning it requires a lot of capital expenditures, money reinvested into the business to continue its operation. So right now, it's pretty monopolistic competition in terms of competitive landscape for Xebec. Most competitors in both RNG and renewable hydrogen have negative operating margins. This is interesting because Xebec is one of the only companies with exposure to both RNG and renewable hydrogen. RNG meaning renewable natural gas. Excuse me if you didn't know that. High barriers to entry considering the business is capital intensive. It requires massive human capital, i.e. skilled engineers and operators, regulatory burdens, and many contracts with large and with government institutions, large companies that is. Technology is new and there's heightened risk of technological obsolescence. So they have proprietary technology. That was one of the big pieces too. Many of the companies had their own patents for these things that encouraged their competitive advantages to move forward. So risks, regulatory change, technological obsolescence, yada, 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 we get that. So what was the bear thesis 4 years ago that stopped investors from catching this stock, Xebec, when it was at rather depressed prices? It was an unprofitable company and its revenue was decreasing. Xebec has existed for 50 years and there's no reason to think now is the time that they will grow. Xebec is a small company that purports to have a huge opportunity, but it's very speculative and not worth the time nor the risk. So we see here in 2015, unless you are very familiar with the natural gas or renewable natural gas aspect of investing, you probably aren't going to be able to pick this company out, sadly. And this is one of those great lessons with the stock market. Like sometimes you just can't expect to find these great businesses that don't really look like great businesses at the time. And you're looking for what you can understand and what you can find, not necessarily the next Xebec that has existed for 50 years and hasn't been profitable and their revenue is decreasing. And how are you supposed to know that they're going to just boom out of nowhere? So that's going to be hard. So future outlook is unsure. Coming in at number 4, we have Appen, APPEN, ticker symbol APX. So 5-year total shareholder return of 4,600%. Again, that's pretty good, if I do say so myself. Coming in at number 4. So Appen is a data management company. That's sort of a hot thing these days. Chastwood and on Australia, that provides machine learning and artificial intelligence applications for technology companies, auto manufacturers, and government agencies. So in 2015, it was trading at 0.67 Australian dollars, and in 2020, it's trading at 28 Australian dollars. It increased from a market cap of 64 million Australian dollars to 3.4 billion Australian dollars, and increased enterprise value. They're trading at a PE of 13. They currently trade at a PE ratio of 40. So that's again one of the key highlights, takeaways, is that the PE ratio has to expand if you're going to get a massive shareholder return. So you're looking for a company that might not necessarily be cheap, but it has room to grow its PE. So it's not selling, for something like 1,000 times earnings or whatever. So it increased revenue from $82 million in 2015 to over $500 million in 2020. That is pretty good. We see here the graph of shareholder returns. It peaked at around this point and sort of evened off from there. So let's continue. Let's look at their business model. What are their primary products? Annotated data used in search technology, annotated speech and image data used in recognizers, machine and translation, machine translations, speech synthesizers, and other machine learning technology. So this is one of the hot industries over the past 5 years: machine learning, data analytics, yada yada yada, big data. You've heard about it. This is an Australian big data company. So let's take a look here by geography. Most of their business, however, is actually done in the United States. So despite the fact that they're based in Australia, much of their business is done within the continental United States. So that's an interesting thing. Next one, big data analytics. Market structure, monopolistic competition, meaning they had a pretty tight grapple over their market. What was the bear thesis? APX was a nano cap stock when it IPO'd. There's not a lot of time nor knowledge of the company for the market to effectively value it. The little data that was presented since the IPO, the first half year-over-year growth was not overwhelmingly impressive to warrant a large price increase. So basically, it was a recently IPO'd nanocap company that wasn't followed. And if you've looked at my other Red Stocks episode, you know that I too have in my portfolio a nanocap company that recently IPO'd and had lackluster results to warrant a large premium. So maybe that'll be the next massive multi-bagger. We'll see. I think it will be. Go check out that video. So APX is a great business. APX has a moat, and it has promising future opportunities. So of all the companies we've gone over so far, this is the one company that it looks like to me is in the best position to outperform into the future. It has time to expand its business into China, and it's been trusted by Apple, Google, and the U.S. government. So that's a big headline right there. Trusted by Apple, Google, and the U.S. government. So it's really a reputable company, and it's a small cap company. Well, maybe a mid cap, depending on how you define it at this point. But it still has the potential for outsized market returns over time. So coming in at number 5, we have Fortnox, ticker symbol FNOX. 2,406% shareholder return over the past 5 years. Number 5, Fortnox operates as a cloud-based platform financial administration for small businesses, accounting firms, associations, and schools. It offers various programs and services. So it's another software company. I actually, so the currency is in Swedish krona. So the stock price was 16 Swedish krona. I don't actually know what the equivalent of that is in US dollars, but it increased that to over 272 Swedish krona in 2020. So that is interesting. I don't know much about the Sweden stock market. So it's a software as a service SaaS company. So it's a variety of cloud-based administrative services, like we said. It has pretty decent barriers to entry, and here we see highlighted the high switching costs. If a company begins to use Fortnox as their software, they will incur significant costs if they want to switch to a competing software. But then again, you see that in terms of competitive disadvantage, where if, say, a better competitor came out with a better service, they would be quickly replaced and it would reduce their new customers because all the companies would be going to them and nobody would be switching to their service. So what was the bear thesis? So what was the downside to the company? Niche company with some growth prospects, but not many. Fortnox product offering is not that large, and their growth will be stunted by lack of breadth. So this is what the bears were saying 4 years ago. So that's interesting to see that they were pretty much proven wrong because they came out with better products. Their current product line was expanded, and their results back that up quite substantially. So Fortnox as a business, it's a high-quality business. It has a moat. It has high barriers to entry, and it has a positive future outlook. So if you like this video, be sure to like and subscribe if you watch this far. Thank you. See you next time.